Good day. Welcome to Marsh Captive Upside 2020 webcast series. It's hard to believe that we're in session 9. We started these sessions when the pandemic hit, and we're already in November, and we've got 1 month to go before the year is over. Today, we've got a really interesting session. We're going to be talking about utilizing a captive for third-party risks. We've got a really cool, trendy company to talk about, and we're also going to be talking to somebody from Marsh, Malta. We're going to be talking about how insurance and third-party exposures in a captive can create potential value, profit center, diversity. And joining us from Hippo Insurance Services is Nicole Perrault, the Chief Risk Officer of Hippo. She's going to talk a little bit about their managing general agency, their insurance company, their captive, and all the cool and trendy things they're doing from a property insurance perspective. Then we're going to go across the pond and talk to David Galea, Deputy Head of Office for Malta and Sweden from Marsh Captive Solutions, who we work with all the time, who's going to talk a little bit about some of the third-party offerings that he's seeing in captives, how they add value, and the growth of third-party business within the Marsh Captive Management captives. So just looking broadly across our spectrum of captives, about 18% of Marsh managed captives write some degree of third-party business. And from 2018 to 2019, that represented a $1.2 billion increase. So you can see that third-party business is certainly trending in captives. There's a lot of reasons why you would want to put third-party business into your captive. Many organizations around the globe have customers, merchants, employees, joint ventures, and there's so many opportunities created with an insurance company and a captive, all the way from customer programs and property, like Nicole's going to talk about, to life insurance, to trip cancellation, whole host home electronic warranty, employee benefits, multinational pooling. With the sharing economy, you've got gig workers, you've got all different opportunities, pet insurance. You've got so many different companies that are doing a little bit different things than they did 15 or 20 years ago. There's disruption going on, and it opens the door to a tremendous amount of opportunity for third-party offerings for companies that you never would have thought might even offer these kind of offerings. So let's jump right into it, and I'm going to hand it over to Nicole to talk a little bit about what Hippo Insurance Service is doing from an insurance and a captive perspective. Nicole, thanks for joining us.
Oh, thanks, Michael, for the opportunity to talk not only about Hippo, but how we work closely with the Marsh Captive Management Company to best insure our risks. So before I get into how we utilize our captive, I'm going to talk a little bit more about who Hippo is broadly. We like to say Hippo is building the leading home protection company. And we underline the word protection here because although we do operate as an insurance company, we are a proactive insurance company, helping our customers identify and resolve issues in their homes before they become major headaches. And I'm going to talk about a little bit about how we implement that and use our captive to benefit that approach. The things that make Hippo different, in addition to being proactive and focusing on holistic home protection, we are very simple to do business with from a customer experience perspective. That is our insurance technology value add. Both our technology is very simple and our customer experience is very simple. We have a very smarter coverage. We're broad, we're tailored to the modern consumer, giving them coverages for things they need and not charging them for coverages they don't need. We have a very broad distribution model. When a lot of people think about insurtech, they think about sort of direct to consumer, the customer being able to go online and buy business. But Hippo believes that customers can come buy insurance any way they want, whether that's traditional means, online, or through some of their home ownership channels. A lot of times customers buy a home and insurance is just part of that equation. So we utilize a very broad distribution model. And we are more than insurance, which kind of focuses a lot on the protection element I mentioned before, but also, like Michael was saying in the previous slide, we are doing things for our customers that are outside of traditional home insurance, including warranty, including our smart home technology process, and we have a Hippo Home Healthcare, which is like a health checkup for your home. And it's all about protecting our customers in preventing claims, but always, of course, being there before to help them manage them when they do happen. So Hippo is an MGA. Hippo Insurance Services is an MGA. We started writing business in 2017. And July, we shared that as of July 2020, we are $270 million in premiums spread across over 20 states. And by 2021, we will be serving 95% of the population. Our core insurance product focuses on home and the homeowner-like products, including condos or investment properties. And we also have a specific program for our builders customers as well, a homeowners program for new build. Next slide. We differentiate ourselves from the legacy carriers. Just again, our onboarding process, you can get a quote in 60 seconds, a bind in 4 minutes. We do continuous underwriting. We include complementary smart home devices within our filed product that allows the customer to prevent potential large losses from things like as water, theft, and fire. And that's a key integral part of our proactive approach. So how does Hippo use our captive to support this risk value chain that we offer our customers? When we, back in early 2020, Hippo was an MGA only, writing on behalf of multiple insurance carrier partners. And we wanted an opportunity to participate and support our risk directly, not only to align our interests, but also to benefit from the underwriting profitability that we will have. So we began a captive, the Cayman domiciled captive, supported by Marsh Captive Solutions, that incepted writing Hippo MGA business in January of 2020. And the Marsh Captive Solutions supports not only our management of it, but also on the regulatory front with the Cayman Island Authority. It writes Hippo MGA business currently as a reinsurer to our insurance partners, whether they're third party or affiliated. We've operated our captive through both a reinsurance front, which is a rated reinsurance party that sits between our captive and the third-party carrier, and as well as direct, where the captive is a direct reinsurer to our third-party carrier. In August of 2020, we have acquired one of our insurance carrier partners, Spinnaker Insurance Company, who you see there in the lower right. And so now our captive can operate as a direct affiliated reinsurer, which gives us not only more control in the placement, but also some additional capital relief benefits as an affiliated reinsurer instead of a non-affiliated reinsurer. So that going forward, our captive would be used to support business across Hippo Enterprise. And I really like the chart that Michael showed in the beginning, because a lot of the things that people are doing outside of traditional insurance, such as warranties, such as insurance services, such as home healthcare checkup, will be supported in our captive going forward to provide holistic home protection for our customers. You know, some of the things, just for if anyone out there is either in the MGA space or is, you know, or you are someone supporting somebody in the MGA space, I just would recommend strongly working with a very educated captive management partner and very educated reinsurance brokers with respect to setting this up. There were a lot of learnings that we had throughout the process that I think working with very educated partners to do this supported learning quickly on the best way to utilize our captive. There's a lot of questions with respect to not only the capital that's needed to go into the captive to insure the risks, but also some of the challenges around collateralizing and supporting, in addition to the regulatory capital, the requirement to support any third-party partner that you may be using your captive as. So there's a lot of nuances that I would strongly recommend working with somebody as, capable as Marsh to work through well in advance of setting up your captive.
Great, thanks so much,
That's
Nicole.
it, Michael.
I was so impressed when we all kind of descended upon Sunnyvale and saw your operations, saw your you went from an insurtech company to an MGA broker to a captive owner to building an insurance company, and you're just going to grow from there. And it just shows you how smart insurtech with great technology, taking risks in a calculated way, can really build your brand and build your strategy. So very happy to see what Hippo's doing, and very delighted that you're happy with your captive and that it helped your organization. Great, thanks so much. So I think what I'll do now is turn over to David Galea, who's going to talk about captives in general, writing third-party business, profiting from third-party business, the benefits involved, and the considerations. David, I'll turn over to you.
Thanks, Mike, and hello, everyone. I'll spend the next couple of minutes on the slide, which illustrates a typical structure. So starting from the top left-hand corner and moving clockwise, we have the customers, which of course are key here, and have an existing relationship with the captive owner. The fronting carrier, which typically has a broader relationship with the captive owner, but would generally enter into contractual relationships with the captive in the form of reinsurance agreements. The captive owner, which brings two important factors into the equation, that is access to the pool of customers, and in many cases, the premium collection function. Next is the captive itself, which is ultimately the risk bearer. At times, one might also find retrocession in place, but since typically the loss profile of this type of business tends to be high frequency and low severity, in most cases, the captive would rather retain the risk than sacrifice underwriting profit. I would say that the key factors that determine success or otherwise of such programs are generally the level of penetration into the pool of customers, because volume plays a very big role here, and managing the cost of claims. The next point I'd like to mention is the main drivers for captive owners, which include improved customer experience, enhanced customer loyalty, and a sense of belonging to the brand, which today is becoming a significant driver. Reduction of churn as well. The captive owner is especially vulnerable to churn when loss or damage happens. Therefore, the captive plays an important role here to ensure claims are paid swiftly and fairly, and to retain the customer, of course. Loss ratios are predictable, and over time, the program could become a profit center in its own right. Finally, the profits from third-party business can be reinvested into the captive to enable it to absorb higher deductibles on the parent's captive program, particularly in the current state of the insurance market. Next, and the last point, is how this is done. Well, typically, such programs tend to be fronted, and that's particularly due to the fact that the fronter brings regulatory and administration certainty. But of course, it also comes at a cost, which could take the form of a fronting fee, risk participation, and collateral, of course. Within a European regulatory context, the program would need to satisfy an array of customer-focused regulation, namely Solvency II, freedom of services, general good provisions, insurance distribution directive, GDPR, and the list goes on. Thus, using a fronter for third-party risks can lighten the regulatory burden, as it is performed by a local carrier, and can help ensure that the policy documents and distribution activities are compliant in each territory. Importantly also, fronting third-party risks can also reduce the risk of creating an establishment over time, referred to as de facto branch. However, we're now seeing how digitalization in insurance is helping overcome some of these challenges, so we're excited to see how things develop in future. That said, the structure could also be managed on a direct basis, maybe using a quota share treaty to phase in the risk retention gradually until claims experience becomes a bit more predictable and stable. But as I said earlier, with the increase in regulation across Europe, a fronted structure tends to be more popular. And with this, I'll pass back to Mike for his concluding comments. Thank you very much.
Thanks so much, David. I guess I have one question for you. In your experience, what types of coverage have you seen across Europe kind of trending or most popular in captives, if you can say?
Yes, yes, most certainly. It's insurance around handset insurance, white goods, extended warranty. So those are the most typical. But I think now we're also going into the next level, and we're seeing also perhaps cyber insurance, so a more holistic handset insurance product, for instance, providing also a certain level of cyber protection, data protection of the data, and the data that is stored on phones. So that's an interesting area also.
Great, thanks, David. And Nicole, maybe just one question for you. Is there anything that you've learned through this process that you wish you would have known beforehand, or any surprises along those lines in building the captive?
Yeah, it's a great question, and the short answer is yes. And it really, it's a specific nuance with respect to the admitted market framework on capital need in our insurance partners. So if you are, as Hippo did, putting in captive on behalf of a third party, which is not affiliated with you, please work out well in advance the requirements that they're going to have with respect to that captive and any collateral in addition to regulatory capital that is needed. Because it's the framework to evaluate it yourself with Marsh, with the Cayman Authority, is pretty well prescribed. But when you have a third party involved, their view may be different. And I would just say work that out as early as you can into your assumptions with respect to how much do you need to actually support up the captive to take the risk.
Great, thanks, Nicole. That's a great point. That's always something that comes up, collateral and capital, and they are very different. And if you get into this sort of equation, you'll learn that very quickly. So thanks so much, Nicole. And thank you, David, so much for participating. That's fascinating what Hippo's doing. And David, there's going to be a lot of third-party business going on into captives in the near future. What's coming next? Happy Friday, everybody. What's coming next is session 10, our last session, December 18th. If you have any feedback or have any ideas of things you'd like to see this year or in future webcasts, please let us know. And if you'd like to access earlier webcasts, the other 8, you'll be able to do that when you get the recording, and you can go on to Marsh website to access those webcasts. So thank you so much. Have a great, wonderful day, everybody, and we'll talk in December. Thank you.